Hey Rick.
Hey Sharon, how's things?
They're good. They're good. Um, I want you to explain the difference, and you had just beautifully explained the different financing options available
Sure.
to a buyer, and these primarily were referring to, I mean, mainly that would have been talking to a person that is buying the home for their personal use.
hmm
Um, but now there are some different things to consider if they want to buy a home. Well, two different things. They want to buy a home either strictly as an investment property,
Okay.
or many people right now, because of affordability issues, wanting to buy the home with an apartment in it to rent out.
Sure.
There are different financing options than the ones we just described more generically for the owner occupied one. Can you talk a little bit about that for us, please?
Of course. So first of all, there's lenders basically look at it in three ways. So a property is owner occupied, which means, it's for just their own use. It's not an investment property. Uh, it's going to be owner occupied with a rental unit, or it's going to be just a investment property, just a rental unit. So basically, if you're buying a straight up investment unit,
Mm-hmm.
you need 20% down.
Minimum.
You cannot, yes, and the interest rate will usually be slightly higher, usually like
Right.
5 basis points or 10 basis points higher than
Okay.
what's available for. Uh, and some lenders will not do just rental units. They, just want owner occupied. So it can restrict your choice of lenders a little bit. There's lots that will though. So,
Okay.
but yes, it is usually a bit more expensive. Now, it's not CMHC insurable, so you are going to be paying a higher interest rate because of that too, because it's 20% down, which makes it a
Right.
conventional mortgage.
Yeah.
And conventional rates are higher than insured rates. But of course, the benefit is you don't have to pay the insurance premiums for CMHC or Sagen or Canada Guarantee, whichever company the lender uses. Um, so there is actually a loophole where you can get an investment property where you don't put 20% down. And the way to do that is you make the house that you're living in the investment property. And then
Okay.
if you're going to buy a new property, as long as you can do as little as 5% down on the new property, as long as the new property is 500,000 or less, you can still get an insurable property, which means like high ratio property, I should say, of up to
5%
999,999.
down.
And it has to be owner occupied.
Right.
Now, the way it works as far as how you qualify for that, you have to be aware that there's two ratios. So when you're buying an investment property, you have to factor in the property you already own as to how you're going to be able to afford that investment property on the total debt service ratio.
Hmm.
So first of all, you've got to qualify on the gross debt service ratio, and we can add back part of the rental income. If we're using a prime lender, like a bank or something like that, usually you get a 50% add back. But some of them are better than others. So sometimes we can use spreadsheets and so forth.
Right.
So I'll look at the different lenders and find the one that's going to, make it the most affordable for you. But generally speaking, you're probably looking, if you're buying and it's like a basement unit or something like that. And in that case, you don't have to have more than 20% down either. That can be a high ratio mortgage. In that case, it is 50% add back, I should say. And what an add back means is that it's getting 50% of the rental income will be added to your income
But
as far as
if you're
qualifying.
living in the home and you're renting out the basement apartment,
Mhm.
so you can do that with 5% down, right? If you're living in the home with
As long as the
occupied.
house is only $500,000, yes,
And
up to 999.
right, yeah. Now also in addition to that, some lenders, again, the advantages of being a broker, we still have some lenders that will do the add back instead of 50%, they'll go up to 80% for the basement income.
So that would be on a conventional mortgage. CMHC is pretty much restricted to the 50%. But
Yeah,
yes, once we get to conventional mortgages, some lenders will use spreadsheets. So they look at, the cost of heating and all that sort of thing gets added in
right.
to the spreadsheet, and the spreadsheet pops out a number, which is often better than just doing a 50% add back. But yes, and if we go with alternative lenders, in some cases, they'll even give like 100% add back for
So
the.
sometimes it's better to consider an alternative lender just to be able to get that kickback, especially, I mean, while the home prices have declined, mortgages are still going, I'm sorry, rent rates are still going up.
The rent market is going crazy. Immigration levels are at all-time highs.
Yeah.
So there's, a lot of demand chasing too few units. So
So if you
now,
get a home with a unit in it, then that rental thing is quite valuable in a tight market that's being squeezed on every side. And so we could have an alternate lender then for 80%, which would make a difference in what someone could afford in a property.
oh, it can make a huge difference. Now,
Because
one
the
thing
interest
I
rates
should
are a little different, but they're not crazily out of control, right? Like,
now one thing I should stipulate though, you can rent out your apartment no matter, if someone's willing to rent it from you, you can rent out your basement apartment.
yeah,
However, lenders do have some criteria that they look at. Not just every basement qualifies
that's
to be a
correct.
basement apartment.
That's
So
correct.
the first thing is it's got to have a separate entrance. If
Yeah,
they have to go in the same door as you, does not qualify.
right,
It needs to have like a living area. It needs to have a kitchen area. It needs to have a bathroom. So you can't share a bathroom. Then you're just renting a room.
right.
Uh, yeah, if it's an actual separate basement unit, then they will consider the rental add back. And if you're buying a house that has an existing unit, then they're probably going to look at they're going to want to see the current lease for how much income can be added back. But conversely, if it does not have a tenant, then they can look at fair market value, which is often higher currently than
That's correct.
because
And that is the part where as a realtor we can come in and do a good job. I mean, I know personally, I understand the requirements for a legal basement apartment, and I'm very well versed in the market rates and where they're going, and the high demand for the apartments and the screening process. So I'm able to take the clients through that. But that's another whole conversation. But thank you. At least it gives us the overview of something that give buyers a few more options for ways to get into a home and start paying their own mortgage.
certainly, I mean, and I mean, we talk about a basement unit, but I've had friends that have bought a house and they lived in the basement and rented out the top floor.
I was going to mention that. Yeah.
Yeah, so it's
Yeah.
sometimes be a little more creative, and it's amazing
Yeah.
what can
And I've had clients that we've done that with. They've taken the basement and there is no requirement. Main floor is main floor. It's already meets building code. There is nothing to prove. So it's 100% rentable. So yeah, excellent thought.
So one thing I want to talk with you about probably in a future video though is I've seen lots of stories about people buying properties where there's a renter there and then they can't move in because the renter won't leave.
We can absolutely talk about that, but let's take that to another video.
Okay, thanks, Sharon.
Okay, thank you, Rick.